In 1688, there was this Spanish merchant in Amsterdam, Joseph de la Vega, and he basically wrote a manual advising people to just constantly roll over their call options, paying premiums forever because, he assumed stock prices would just always go up.
Right, which sounds exactly like a forum post from a modern day trader running on blind optimism today.
Totally. It sounds like something you'd read right now. But we're talking about 17th century Amsterdam. Welcome to this deep dive. Today, we're exploring 𝗔𝗿𝗱𝗏 research, the early history of option contracts.
And, for those of you listening who might feel a bit intimidated by modern financial jargon, words like derivatives or put and call options,
Okay.
this is really your shortcut. It completely shatters the illusion that modern finance is some impenetrable fortress built by supercomputers.
Yeah, exactly. Our mission here is to demystify these tools by looking at their surprisingly dramatic history. Beneath all the complex math of Wall Street, there is just a very basic human story about, well, managing risk, predicting the future, and quite frankly, gambling.
It really is. The architecture of these complex derivatives was actually forged centuries ago in these chaotic, muddy street markets.
So just to set the baseline using the text definition, an option contract simply grants the right, but not the obligation to buy or sell something at a later date under stated conditions. Okay, let's unpack this. Where do we even start?
Well, to find the first documented attempts at managing future risk, 𝗿𝗱𝗏 actually takes us all the way back to the ancient Greeks. Specifically, there's a story from Aristotle's Politics about the philosopher Thales of Miletus.
Oh, right, the olive press guy.
Yes, exactly. So Thales supposedly used his knowledge of meteorology to predict this massive bumper crop of olives. And he took a small sum of money and paid what Aristotle calls earnest money to secure the hire of all the local olive presses in advance.
So he locked them all down.
Right. And when the harvest boomed, everyone needed an olive press at the exact same time. Thales had the monopoly, rented them out at a huge premium, and basically made a fortune.
I mean, I read that and immediately questioned Aristotle's framing of it. Thales wasn't some wizard. Predicting the weather 6 months out in ancient Greece is, well, it's impossible.
Yeah, he didn't have a satellite dish.
Right. So to me, this sounds a lot less like a magical weather forecast and much more like, paying a non-refundable deposit to put a hold on a wedding venue.
That's a great analogy.
Right, because you pay the venue $1,000. If the event doesn't happen, you don't owe them the rest of the massive bill. You just lose your deposit. Thales was just capping his downside.
That is the precise mechanism. He risked a little earnest money for potentially huge upside, but crucially, without the obligation to rent the presses if the crop failed. But relying on those loose merchant conventions in the ancient world presented a really glaring structural problem.
Which was what? Exactly.
Well, we see it vividly in a much older example from Genesis 29, the biblical story of Jacob. So Jacob works for 7 years for Laban, right? And his negotiated payment is the option to marry Laban's youngest daughter, Rachel.
Oh, yeah. And then the settlement date arrives and Laban pulls the ultimate bait and switch.
Exactly. He just refuses to deliver Rachel and gives Jacob his older daughter Leah instead.
Yeah.
What's fascinating here is that this biblical story illustrates the primary existential threat to early financial instruments.
Which is delivery failure.
Yes, delivery failure. What good is a forward contract or an option if the seller just refuses to honor the deal when the settlement date arrives?
Yeah.
In ancient and medieval times, you didn't have a centralized legal system enforcing these abstract agreements.
So the counterparty risk basically destroyed the instrument's utility. Rampant delivery failure like that inevitably forces a structural evolution, right?
Absolutely. Merchants realized that if they wanted to trade future obligations at scale, they couldn't just rely on handshakes and localized honor codes. They needed a regulated, centralized environment.
And that necessity birthed the great European bourses, starting with the Antwerp Exchange in 1531.
Right. Antwerp is really the inflection point. The authorities there did something revolutionary. They separated physical commercial transactions from purely financial ones.
So they created a space just for the paper trading.
Exactly. Once you create a dedicated space solely for paper speculation, human nature just accelerates the innovation. During this period, seaborne trade was expanding rapidly. Merchants needed to trade grain that was still weeks or months out at sea.
What they called to-arrive goods.
Right, to-arrive goods. So they created these standardized forward contracts to lock in prices for those shipments.
But, a forward contract is a rigid obligation. If I promise to buy your grain in 2 months and the local price of grain collapses before your ship arrives, I'm going to face catastrophic losses. I might even default.
Which brings us right back to the delivery failure problem. To prevent those defaults, the traders innovated an escape hatch. They introduced an option-like feature called the 𝗧𝗿𝗱𝗱𝗀.
The 𝗧𝗿𝗱𝗱𝗀. Okay, let me make sure the math is clear on that for anyone listening. Let's say we enter a forward contract for that grain. We negotiate a condition where, for an upfront fee, the 𝗧𝗿𝗱𝗱𝗀, I have the right to withdraw from the forward contract entirely.
Right, so let's run the numbers.
Okay, I agree to buy grain at 100 guilders. I pay you a 𝗧𝗿𝗱𝗱𝗀 5 guilders. If the market price drops to 50 guilders, I don't buy your grain at 100. I just walk away, lose my 5 guilder fee, and save myself from a 50 guilder loss.
Exactly. You are buying the privilege of breaking your own promise. And that exact commercial utility is what migrated to Amsterdam in the 17th century. And once it got there, it exploded.
Because speculators started applying these tools to joint stock companies, right? Specifically the Dutch East India Company.
Yes, and we know the intimate details of this from Joseph de la Vega's 1688 book, Confusion de Confusiones. He documents a market that is just overflowing with what he literally termed out-and-out gamblers.
I love that phrase, out-and-out gamblers.
Right. These were traders who borrowed heavy sums just to pay option premiums, basically to cover up their previous bad debts.
Here's where it gets really interesting. Because while they were treating the Amsterdam Bourse like a complete casino, they simultaneously engineered one of the most sophisticated logistical solutions in financial history.
Yes, the 𝗧𝗿𝗱𝗱𝗀. It solved an impending physical nightmare. Imagine thousands of speculators trading paper contracts on East India stock. When the contracts mature, how do you actually settle them?
Because moving massive physical piles of stock certificates and securing all the gold coinage required to pay for them, that was dangerous and probably logistically impossible.
Totally impossible. So instead of physically exchanging the assets, the representatives of all these traders gathered around a table every 3 months.
And they tallied up all the overlapping contracts, canceled out the opposing positions, and simply paid out the numerical differences in cash.
Exactly. Netting. If you owe me 100 for a stock and I owe someone else 90 for that same stock, we don't physically move the shares. We just calculate the netting and you hand over the 10-point difference.
Abstracting the trade away from the physical asset, focusing entirely on the price movement. That is basically the bedrock of modern derivative exchanges.
It is. And this concentration of liquidity made the Amsterdam market incredibly efficient.
But of course, an efficient infrastructure doesn't protect a market from mass delusion. Which naturally brings us to the most famous speculative bubble in history, the tulip mania of 1634 to 1637.
Yes, the tulips.
Because the popular narrative is that weavers and cobblers and bakers were wildly trading options on tulip bulbs that were still in the ground. But our source text offers a massive historical myth bust here.
It really does. According to Poitras, the traders driving the tulip mania were not using options at all. They were using binding forward contracts.
Right, and the distinction is critical. They weren't paying a 𝗧𝗿𝗱𝗱𝗀 for an escape hatch.
No, not at all. They were locking themselves into absolute rigid obligations to buy bulbs at astronomical prices upon delivery.
It is completely identical to getting a house off plan in a hyperinflated real estate market today. You sign a binding contract to buy a luxury home that hasn't even been built yet for $1 million.
Right.
But before the foundation is even poured, the housing market completely crashes. That unfinished house is now worth maybe $100,000. But you are legally obligated to pay the $1 million.
Which means total financial ruin. Your only move is to desperately scour the legal code for a loophole to cancel the contract. And when the tulip market collapsed in February 1637, thousands of buyers found themselves in that exact scenario.
Facing unpayable debts for practically worthless bulbs.
Exactly. The defaults were so widespread they threatened to freeze the entire Dutch economy. So, to prevent total gridlock, the legal authorities had to intervene.
If we connect this to the bigger picture, the courts essentially looked at the carnage and applied older historical edicts to alter the contracts retroactively.
Yes. They allowed buyers to repudiate their binding forward contracts by paying a standardized penalty fee to the seller. It was usually between 1% and 5% of the actual losses.
So the legal system forcibly transformed binding forward contracts into options after the fact.
Exactly. That 5% penalty functioned exactly like a 𝗧𝗿𝗱𝗱𝗀𝗀 premium. The structural flexibility of the option contract didn't cause the tulipmania at all. It was deployed as a triage mechanism to clean up the wreckage.
Wow. So the Dutch legal scramble established this robust framework, and then after the Glorious Revolution of 1688, this financial technology was exported across the Channel to London.
Right. It landed in places like Jonathan's Coffee House and Exchange Alley, and we see the mechanics crystallized perfectly in a 1694 circular written by John Houghton.
He details the pricing of what they called refusals, right? Which is a call option.
Yes. He describes a trader paying 3 guineas down for the right to accept or refuse a share of East India Company stock at £75 within 3 months. And his sample contracts reveal an astonishing level of sophistication.
Because these late 17th century options were already transferable to third parties. They even included specific clauses for dividend payout protection.
Yeah, it's wild. Furthermore, historical texts from traders like Isaac de Pinto show that the speculators in these coffee houses intuitively grasped complex mathematical relationships. Specifically, put-call parity.
Okay, put-call parity is the foundational math of modern option pricing theory. Stuff like the Black-Scholes model. The fact that de Pinto understood it hundreds of years before academic finance even existed is insane.
It really is.
Let's walk the listener through the actual mechanics of how a 17th century trader executed this. They knew how to replicate the payoff of a put option, meaning profiting when a price drops by combining a call option and a forward contract.
Okay, let's trace the logic they used. Suppose you hold a call option granting you the right to buy a stock at 100. Simultaneously, you enter a forward contract obligating you to sell that same stock at 100.
Okay, so if the stock price rockets up to 120, my call option lets me buy it at 100. But my forward contract forces me to sell it at 100. The two positions just cancel each other out. My upside is completely capped.
Exactly. Now consider the inverse. The stock price crashes down to 80. Your call option to buy at 100 is useless, right? So you just let it expire.
Right.
But then you go to the open market and buy the stock for 80. Your forward contract forces the other party to buy it from you at the agreed 100. So you pocket the 20-point difference.
So by capping my upside with the forward and letting the call expire on the downside, I have created a synthetic position that purely profits from a market crash. I have basically built a put option out of spare parts.
You really have, and that is incredibly elegant math to be doing over a pint of ale in a noisy coffee house.
Well, wait, if they were doing this sophisticated arbitrage, why did the British Parliament despise these traders so much? They aggressively tried to stamp this out.
Well, the government's hostility was driven by the predatory application of these tools, specifically a practice called stock jobbing. Wealthy syndicates would manipulate the options market to execute what we now recognize as a short squeeze.
Oh, a short squeeze. The mechanics of a short squeeze haven't changed at all. A syndicate quietly corners the physical shares of a stock in the cash market.
Right.
Then they target amateur traders who have written or sold call options without actually owning the underlying shares. These are called uncovered calls. The amateur assumes the stock will just stay flat, so they pocket the premium.
Then the syndicate aggressively bids up the price of the stock. And when the price moons, those amateur option writers are contractually forced to deliver shares they don't own.
They have to buy the stock at any price to fulfill their contracts.
Exactly. And the syndicate, which controls all the shares, sets the price astronomically high. It completely financially ruins the option writers.
I mean, that rampant manipulation caused massive public outrage. It led Parliament to pass Barnard's Act in 1733, which made options trading outright illegal in England under penalty of a £500 fine.
But the legislation was entirely performative. The brokers simply moved the trading off the official books. It was just too profitable to abandon, and they relied on their own reputations to enforce the contracts.
So while England tried to sweep options into the shadows, France decided to actually institutionalize them, which resulted in a spectacular state-sponsored disaster.
Yes. Between 1716 and 1720, the French government allowed John Law to intertwine the national debt with his Mississippi Company. Speculators were driving up the forward prices of the company's stock, which threatened Law's control.
So to absorb this speculative demand, Law issued what he called primes.
Right. And primes were effectively at-the-money, 6-month call options for company stock, fixed at a price of 10,000 livres.
Yeah.
Law's intent was to stabilize the market.
But instead, the public sold their actual cash shares in droves just to buy the primes.
Which seems irrational until you factor in the intoxicating mathematics of leverage. Imagine owning one physical share worth 10,000 livres. You believe the stock will rise, and you want to maximize your exposure.
Okay, so you sell your one share for 10,000 in cash. Laws primes, the options cost 1,000 livres each. With your 10,000 in cash, you purchase 10 primes.
Exactly. You trade 1 unit of underlying asset for 10 units of upside exposure. But the macro effect of thousands of people executing this strategy simultaneously is fatal.
Because everyone is dumping the physical stock on the open market to raise the cash to buy the derivatives, they crash the underlying market to buy the derivatives based on the market.
The tail aggressively wags the dog. The cash price plummeted, the Mississippi scheme collapsed, and the economic trauma was so severe it ruined the French public's trust in financial securities for generations. The stigma associated with options became deeply entrenched.
So what does this all mean? We have England banning the practice, France suffering national trauma from it, and this intense cultural suspicion eventually crosses the Atlantic to the United States.
Yes. By the 19th century, U.S. stock and produce exchanges strictly prohibited option trading. It was banished to the curb, literally traded out in the street.
And the U.S. markets had their own manipulators reinforcing the stigma, right? In 1875, Jacob Little used options to execute a massive short squeeze on Erie stock. That severely damaged the reputation of American options trading all over again and resulted in strict 60-day maximum term limits on contracts.
This raises an important question. How did the structural DNA of the contracts themselves diverge between Europe and the United States due to these differing cultural environments?
Yeah, how did they evolve differently?
It really comes down to settlement, logistics, and trust. In Europe, they maintained those scheduled risque-entre delivery days. They met quarterly or monthly. Because they settled on specific dates, they used adjustable strike prices.
They would set the strike price based on the actual market price on the settlement day, right? Known as making up the price. And the premium would fluctuate accordingly.
Exactly. But the U.S. practiced daily settlement. Every day was a settling day. You couldn't wait for a quarterly meeting to establish baseline prices. Furthermore, because the U.S. market viewed options as disreputable gambling, there was absolutely zero trust between counterparties.
So traders demanded the strike price be rigidly fixed in the contract the very moment it was signed, and they required the premiums to be paid entirely in cash up front.
Yes. The intense cultural suspicion in America literally dictated the mathematical structure of the instruments. They engineered the contracts to minimize counterparty risk in a market devoid of institutional trust.
As we bring this deep dive in for a landing, the trajectory of this history is just staggering. I mean, we started with ancient philosophers paying earnest money for olive presses.
Right, and then we examined Dutch courts retroactively modifying forward contracts to save an economy from tulip defaults.
We saw London coffeehouse patrons intuitively synthesizing put options over pints of ale. And we watched American distrust force the creation of fixed-strike, cash-upfront contracts. The overarching takeaway from Poitras's research here is that the fundamental mechanics of option contracts haven't really changed in 4 centuries.
No, they haven't. They're basically human tools designed to navigate an inherently unpredictable future, forged through a lot of trial, error, and catastrophic failure.
So for those of you listening, the next time you hear a news report about complex derivatives or stock market options, do not let the Wall Street jargon intimidate you. Strip away the supercomputers and just picture a 17th century trader sitting in a noisy London coffeehouse, handing over 3 gold guineas to cap his downside on an East India Company voyage. It is the exact same mechanism.
And, it leaves us with a really provocative thought to mull over. We saw how traders in the 1600s successfully executed complex mathematical principles like put-call parity purely through market intuition, long before academic finance departments even codified the equations.
Yeah.
When we look at today's immensely complex algorithmic trading models, it makes you wonder, are these supercomputers actually discovering new fundamental truths about financial markets? Or are they simply executing the exact same intuition of a 17th century merchant just a few milliseconds faster?